If I didn't own a single property and had to start over today, here's what I would do. I've been investing in property for over 5 years at this point, and it all started with this property right here that I bought with my business partner for $182,000, not knowing a thing about what we were getting ourselves into. And it's crazy to look back on this considering it was a small duplex that kickstarted my love for real estate investing and has, in a sense, brought me to where I am today, acquiring larger and more lucrative opportunities. But we certainly made our fair share of mistakes over the years that, if I'm being honest, have cost us tens of thousands of dollars in wasted capital and time, or if we had the opportunity to start over again, we would do things very differently. And hey, I get it, times have drastically changed over the years. It is impossible to buy a duplex in this day and age for 182 grand, no matter where you're located, but you can still learn from my mistakes. So considering that properties have basically doubled in price, interest rates have come up substantially, municipalities are cracking down on short-term rentals, room for error has become even smaller. So hopefully today's video will give you a couple of viable options to explore. All right, so back when we initially bought the 182 grand duplex, one thing that we did do right was utilize an owner-occupant loan, allowing us to use a down payment of only 5% of the property's value. In this case, that represented a mere $9,100, which was perfect because when you're starting out, capital, of course, is always limited. So a small down payment leaves some extra room for cosmetic renovations and other running costs. Now, I have seen so many new investors get caught up in trying to avoid paying mortgage insurance that they park 80% of their entire net worth into the down payment on a deal with a 20% down payment. And although there's nothing inherently wrong with doing this if you do have the means, because you are going to be lowering your monthly payments, of course, but you're also putting most of your eggs in one basket and tying up capital that can't be used elsewhere, which is huge when you're starting out. In fact, let me break this down for you. On a $500,000 property, a 20% down payment is $100,000, whereas a 5% down payment is only $25,000. So if you're just starting out, that $75,000 more out of pocket is probably a huge portion of your savings, and it could even take years to stack up that additional capital, in which time, who knows how the market will have changed. So if you opt for the lower down payment, you will have to pay mortgage insurance that is added to your mortgage loan in the amount of 4% of the loan's value, which means an additional $19,000 is added to the mortgage in this $500,000 home example. And you might be thinking to yourself that this sounds like a terrible deal. Your loan is higher and you're paying more out of pocket each month. And to this, I would say that for certain properties, yeah, it might not make sense. But for a rental property where the tenants are the ones paying off the loan and where there's potential to create value add to increase the property's value if done correctly, the upside could be significantly higher than the mortgage insurance premium that you're paying on the loan in the first place. This is something that I've done a handful of times with my partner and would seriously consider if you're new to property investing and need as much financial leeway as possible. The next thing I would avoid if starting over today would be jumping into property investment without a proper strategy for the first deal that you're looking to buy, and how that's going to potentially tie into a 5 or 10-year plan for yourself. Now, the reason I mention this is because if you're watching today's video, chances are you're interested in real estate, so you consume content on social media about investing. And this can be both beneficial to getting you motivated and geared towards investing, but it can also cause analysis paralysis and confusion on whether or not you should be buying a duplex or low rent housing or flipping condos, doing Airbnb. All of these facets of real estate can be very lucrative, but especially when you're first starting out, it is critical that you look within at your own goals and financial situation to pinpoint one strategy that you want to start with and then stick to it. You'll very quickly see that while real estate investing can often be very rewarding, flipping, it's a long game that won't generally give you short-term financial gratification, no matter what facet of it you jump into. So figuring out what strategy you want to deploy for a couple of years before acquiring your first property will allow you to avoid changing course prematurely and therefore leaving money on the table. Moving on, one of the most important things I would do as a new investor is systemize my deal analysis process to make it quicker and more thorough, along with managing my tenants and properties in a more efficient manner, which is exactly what today's video sponsor, Lendlord, is here to help you accomplish. Lendlord is an all-in-one portfolio and property management suite that's great if you're a current landlord looking to better keep track of and drill down on your portfolio's performance, just as much as if you're a new investor looking to get an edge on analyzing deals in your area. This is made super simple with their deal and flip analyzer tools that are integrated right into the platform. Let's take a look at how you can use these to your advantage. So to analyze a rental property deal, it's super simple. You start off with inputting the property's address, followed with other valuable information about the income, projected expenses, and even projected renovation costs of the property. As you input values, projected returns and metrics will update in real time, giving you a quick but detailed idea of the deal's financial potential. Once you're done, you can save the property analysis and export the values in a comprehensive report if you feel like it. And hey, if you do end up acquiring property to start your very own portfolio or already have some rentals under your belt, Lendlord is a great platform as well to keep track of your portfolio's growth and key performance indicators. You can easily link your bank account and keep track of rental income, expenses, tenants, and dozens of other relevant portfolio values that you would expect from a portfolio tracking system. So make sure to check out Lendlord today if you want to better analyze potential deals using the link down below in this video's description. And I got them to offer you a 3-month free trial to their premium account using my link exclusively. So if you want to support the channel, please check them out and create a free account with my link. Let's get back to the video. So in parallel to the last point of having a proper plan in place before starting, it's also super important to get the right type of financing for the deal or project that you're moving forward with. All right, and I say this because if you're going to be buying a fully optimized duplex for consistent and convenient cash flows, well, your financing will most likely differ quite a bit from if you're buying a rougher property with the goal of refurbishing and then refinancing. And I mentioned this for a few reasons. The first one being that I recently took a consulting call with an old coworker of mine who ended up buying a duplex, which I was super happy to hear about, but he did make a couple of beginner mistakes, like putting 20% down, which was most of all his money. He fully renovated one of the units, doing most of the work himself and paying for the renos out of pocket, and has a locked-in mortgage rate of 5 years. So by doing this, he had over 150 grand of his own money tied up in the deal, and when looking to refinance, would have to pay a substantial fee to break the mortgage since it was a fixed rate mortgage and he was only 1 year into a 5-year term. And by the way, if you're watching this right now, like I mentioned to you, we made the exact same mistake several times at the beginning, but there lies the importance of getting the right type of mortgage product for your specific deal that you're after, which is why I always recommend working with a mortgage broker who can explain to you the difference between fixed rate, variable rate, open mortgages, and so on. One of the next things I would focus on greatly if restarting my property business would be better valuing my time and delegating appropriately for things that I'm simply not good at. The thing is, you'll quickly realize that there are so many different moving parts to a property business, and so it's nearly impossible to do everything yourself at a high standard. This is something that I still struggle with to this day because I like being hands-on and in control of my business, but as a business owner, it's more advantageous to know when to delegate and pay someone to do a better job than you could do in the first place. Here are a couple of examples of things that we have delegated in our business. So a property manager who deals with the tenants and ongoing monthly issues, a contractor that does all of the renovating, a leasing agent who finds tenants for our units, an accountant that takes care of all of the accounting, of course, cleaners who clean the units on tenant turnover, and the list goes on. At the end of the day, you only have so many hours, and your time is probably better spent overseeing the properties and searching for new deals. And it's important to remember that all of these services are tax deductible anyways. Okay, so with everything that we just covered in this video, here is what I would do if I were starting from fresh and considering I had very little capital to work with at the start. So the absolute first thing I would do is spend a couple of weeks watching videos and reading books about property investment to gain some knowledge and get a good feel of the basics of real estate so that I could lean towards one strategy over another. And by the way, my YouTube channel has loads of free content that you could check out if you want to learn more about real estate investing, specifically long-term rentals. The next step for me would be one of two things. Either look for a partner that I can work with who has complementary skills and value, along with conducting research on the area that I want to invest in. If I was in Vancouver, obviously I wouldn't be investing there, so I'd be looking for a smaller multi-unit property outside of the city, or maybe even outside of the province that had lower rent and unit that needed slight refurbishment. From there, step 3 is to build out an on-the-ground team for your business, including a property manager, an inspector, a contractor, mortgage broker, and so on. That'll help you manage the property and future properties as well in your larger portfolio. This is one of the most important steps that you cannot overlook because you cannot do everything yourself. From here, I would narrow down my search to a handful of properties that fit within my budget and criteria and would put as little down as possible on the property while knowing that I can sustain any losses during the refurbishment process towards a refinancing. Most properties you can get your hands on right now for a good deal have work needed, which is where the money is anyways though. So if it's an already renovated and optimized property, well, it's the seller that's going to be making most of the profit, not you, because you're buying their end product. So you need to focus on creating value if you want to be able to scale the portfolio with limited capital at the beginning. Now, the property I would buy would most likely be a duplex to start out, as this is a property size that's manageable for a beginner while giving you experience dealing with tenants and having a rental property. You'll also be able to get the best financing rates on a smaller multifamily residential property and can pick up a deal for much less than, say, a triplex, fourplex, or even 5-unit building. So to summarize, it's never too late to get into rental property investing. You just need to put in the time and the effort to learn how to find a good deal. And if you want to learn more about my entire strategy from start to finish, how I've gone and acquired many rental properties over the past couple of years, make sure to check out my full real estate investing course. Again, thanks a lot to Lendlord for sponsoring a portion of today's video. Make sure to check them out, link down below in the description, for 3 months free of their premium service. So with that said, thanks for watching. Make sure to check out this video if you want to learn more about how to acquire your first property. And with that said, I'll see you in the next one.